welcome to the first of our market updates for 2022. And we thought we'd kick off the year with a little bit of a look back on 2021 and the performance that we saw across sort of the key markets throughout the course of last year, as well as sort of put that into context with what we've seen through the month of January this year, which has been clearly quite difficult in terms of financial market performance, and we've seen a number of markets down quite significantly over the last 3 to 4 weeks or so. And just then think about that in the context of what we've seen and our positioning in terms of our portfolios, certainly through the first quarter of this year. And we just want to show this via a chart that we have here. If you just provide you a bit of a snapshot in terms of the performance of financial markets, calendar year returns through 2019, 2020, as well as 2021. And you can see there that, by and large, we had positive performance, quite significant positive performance over that period, mostly out of growth assets. Equities did very well, while certain markets, whether it be in the REITs or even the defensive part of the market in bonds, actually struggled. And we've now seen sort of a slight reversal of that through the early stages of 2022. In our view, if we look through that, you can see returns in equities are in mid to high double digits, and we've seen a flat to negative return out of bonds. And our focus from an asset allocation perspective over the last couple of years has certainly been weighing towards that exposure to growth assets, and as I said, that's benefited portfolio performance. And our concerns from a bond market perspective has been that we've seen obviously interest rates in negative territory. We've seen real yields well negative. And we're now in an environment with inflationary expectations rising around the world and certainly remaining higher than central banks would like to see. We're now in a market environment where rate rises are most likely to be on the cards. And certainly, if we were looking at the US Federal Reserve as an example, they may kick off their rate rises in March, along with obviously reducing their size of their balance sheet. So in effect, QE tapering starting to come to the fore. Now that's having implications right across the world for financial markets and the repricing effectively of risk and the repricing of those parts of the market that are sensitive to higher bond yields and to higher real yields. And we're starting to see that play out most notably in the tech sector, particularly around excessive valuations, and that's flowing through in terms of market performance, certainly through the first 3 to 4 weeks of January. But when you look at the performance that we've seen over the last couple of years, and we look at the earnings growth going forward that we expect in financial markets through the course of 2022, we don't think that this recalibration effectively of equity markets is all doom and gloom, and we don't necessarily believe that it's going to necessitate that this is going to be the norm for this calendar year. We think market volatility is going to be elevated, and we certainly expect that to be the case, given that we're going to be in a rate rising environment. We haven't seen that pretty much for the last decade or so, as well as in a higher bond yielding environment as well. And that's going to have implications around valuations for equity markets, and certainly for parts of the equity market that have enjoyed lower cash rates and negative yields and been able to take advantage on that. So in the context of that, we think it is going to be a more challenging investor environment. But I think what's important, again, when you look at that chart, that the defensive part of the market, think about it in terms of treasury-based securities, whether it be Australian or global, that you're looking at negative returns for those asset classes. And from our perspective, when we look at the relative valuations, the relative opportunities, it still leads us to be overweight growth assets, but we're clearly mindful of the type of growth assets that we want to add into our portfolios. The other element from our perspective is the ability to invest in assets that can take advantage of higher inflationary expectations if they are maintained throughout the course of this year, and the requirement of that, particularly around cash flows, to take advantage of floating rate cash flows that can benefit from higher inflation over the journey. So from a portfolio standpoint, we haven't made material changes through the month of January. We're certainly sensitive to the fact that we are likely to be in an environment where central banks are going to be turning off the liquidity tap, and sensitive to an environment where interest rates are likely to rise throughout the course of this year, as I said, certainly with the Fed beginning in March, and the potential that the RBA may move, albeit that we don't expect any changes in RBA policy throughout the course of 2022. But financial markets may start to price that in, and we may see again domestic yields continue to move higher as they have through the month of January. That's going to be challenging for fixed income markets as much as it's going to be challenging for equity markets, and that recalibration, in our view, is something that investors need to be mindful of. And when you're thinking about the performance that we've seen, particularly through 2019 and 2021, albeit hard to believe 2020 was also positive for risk assets. But when you look at the performance over those 3-year periods, when you then sort of take into consideration the average returns were, well north of mid-single digits, we think that the overall profile that we're seeing, and as I said, the recalibration and repricing of risk in equity markets, particularly through the month of January, we don't think that that's out of sync with what you would expect given what we've seen in financial markets over the last couple of years. It's not necessarily great for investors, particularly those that are just going into the market. As I said, it's all about positioning, and from a portfolio and asset allocation standpoint, as I said, we're very mindful that defensive assets are potentially also likely to be under pressure, particularly those that are interest rate sensitive, such as treasury markets and the like. So clearly a pretty difficult period early on, but as I said, we don't expect that the month of January is going to be the norm throughout the course of this year. But I think it does highlight that investors need to have a focus on having a broad, well-diversified strategy, as well as maintaining a focus on what markets have done over the journey, and then balancing those portfolios and balancing that asset allocation framework akin to the risks and return profile associated with those underlying investments. As always, if you have any queries regarding your portfolios, please feel free to reach out to anyone of our advisors. Thanks, and we look forward in catching up again throughout the rest of this year. Bye for now.